Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods, and today I'm talking about setting up covered calls. So this is when we buy stock and then we sell a call option against it to give ourselves a yield boost on top of the dividend that we're already collecting. All right, as you guys know, I'm not a professional investor. I don't work in the finance industry. This is an opinion channel about money, and I have an opinion about options because I love them. Generally speaking, I'm a dividend investor and I'm an options investor. Those two things kind of hand in hand. Now, because I'm a Canadian, I invest a lot in dividend paying equities in Canada, and my option trades are almost entirely American. But one of my patrons asked me a question the other day. He said, hey, what about selling covered calls on one of the Canadian products that you invest in? So he asked me, he talked about 3 different stocks, and I happen to own 2 of them already. So what we're looking at today is we're gonna look at Surge Energy, we're gonna look at Alta Gas, and we're gonna look at Inter Pipeline. Now, these are all in the Canadian exchanges, but don't let that fret you, because if you're an American watching this, and I know I have lots of American subscribers, the kind of information that you're getting on this video is actually going to show you what I'm looking at, and you can see kind of my thought process on whether or not this might be a good thing to look at in your own portfolio. So let's just dive right into this. The columns that we're looking at, the first column is the stock price, the next column is the change today, the third column is the percentage change, so 5 cents relative to the 1924 that the stock is currently trading at means it's down 0.25%. And then this last column is the IV rank, and that's something I look at specifically for option trades. What I usually want to do is trade on a stock when the IV rank is above 30. So quick look at these. Alta Gas just under 30, so like maybe we could put a trade on it, maybe we couldn't, depending. But when we get into a low IV environment, we're running the risk of that IV expanding or the volatility becoming greater. When the volatility increases, the price of the options increase. I don't want to be in a position where I'm selling when it's at a low value and then buying it back for a higher value. That doesn't make sense. I want to sell when it's a high value and then buy it back later when it's a lower value. So that's the buy low, sell high, and we're just reversing that in option trading. We're always selling high and then buying low later. That's the kind of the strategy. We use theta decay to our advantage. So let's take a look at these 3 products. First of all, Surge Energy, $1. I doubt that there's enough options around that to be viable. I mean, I'll pull up the options chain for you guys. We're looking at literally the strikes are $1, $1.50, $2. And of course, the $1 strike on the call side, the bid is 6 cents and the ask is 15 cents. That's way too big a spread. There's probably not enough volume. Yeah, there's only 40. For that reason, Surge Energy is out. Cannot trade options on that and expect to make money. So for today's video, we're only looking at the call side because the idea is we buy the stock, we're collecting the dividend, and then can we sell a call to make more money off of it? So let's pull up the IPL chart here. So it's trading at 22.09. I'm going to be looking for a delta value. I just go straight to the delta column, and I'm looking anywhere between like 16 and say 24. So if we go down here, 24, that's $23. Again, we look at the bid and the ask. The bid's 5 cents and the ask is 21 cents, which means if we bought and sold today, we would be selling for 5 cents and buying back for 21 cents. That's a huge loss. We cannot do that to ourselves. This spread has to be much tighter. Usually this is an indication of low volume. If we take a look here, 330 contracts traded or open. The volume today is 0. So we have 330 open contracts, volume 0. Again, not enough liquidity to make this a viable play. So IPL is out. Now let's take a look at Alta Gas. Now this is a bigger company. I would expect that there might be some action in here. I'm hoping that there's some action in here that we can look at. So we've got 2 things happening. We've got the November expiration and then we've got the December expiration. Now I always like to trade on the monthlies because there's usually higher volume, so lesser risk, tighter spreads. So again, we look at this, we're looking for delta anywhere between 16 and 24. So this delta is 20. There's 3,000 contracts open, none traded today, but at least there's 3,000 open. That's pretty good. And we're looking at this, the bid ask spread is 4 cents. So not bad. For this is December. Sorry, I'm on December, 57 days. Let's look at November. So do we have anything here? Ooh, this one, $20 strike, 23 delta, 874 volume. 18 cents to 21 cents. Again, not terrible. Basically, if we sold this, if the stock went over $20, we would be selling it for $20. So it really depends on the price that you actually paid for the shares in your account. We're going to assume that we're going to buy it today, and I'm going to take a look at a chart. So we're just going to look at these numbers. So we're November 15th is 22 days away, and the $20 strike is, we could probably sell it for 18 cents. So $19.22 is the current price. So here's a little spreadsheet that I've built. Now this is available to my patrons, my options patrons, if they want to download it, or if you're interested in purchasing it, you can purchase that on my Etsy store. I'll make that available. Anyways, it's got some really basic information in here, but it allows a kind of graphically to show us the kind of amount of money that we can make. So the first thing I need to do is fill out my trading account. Now for my American friends, you're probably at a zero transaction fee here, but here in Canada we pay $10 usually, and we also pay $1.25 per option contract, and then our assignment fees are usually pretty high too, so I'm about $43 in that. That's like a typical account, TD Direct Invest. Yeah, most of the brokerages are charging around this through the big banks. So what did we have? We had that information. 1922 was the stock price, and then the short call strike we said was $20. That's the strike price. And then the short call, the current price of that strike is 18 cents. And the days to expiration 22. So we're going to type in all that information, and then all of a sudden the chart is populated. So just literally filling in these 7 cells, and we have all of this information. Now, the idea with covered calls is we would have to own some shares. So if we own 100 shares, we would look at this first column, and the cost to buy them today would be $1,931. We could then sell one options contract against that. For that, after our fees, we would collect an extra $6.76. Now you'll notice this is highlighted in red, and all three of these cells are. The reason that they're highlighted in red is because at that current price, at 18 cents, after our commission fees, the value of money collected is actually less than the assignment fee. So that's what this is. These numbers are direct correlation to the assignment fee. If your assignment fee is only $5, then these will not be red. That is why those are red indicators for people that have high assignment fees. Because what this means is if you bought 100 shares, if we bought them today, it would cost us $1,931. Where did I get that information? It's a calculation based on a transaction fee of $9.99 plus 100 times 1922. And that would be the cost out of my account being debited to purchase 100 shares. Then selling the call would generate $6.76 in income. So the total capital at risk at that point would be $1,925. You can see where I'm getting this math. 1925 is 1931 minus the 676 we collected. Now, this premium collected return on investment is a direct correlation to the original amount invested and the amount of income that we can make off of it in this 22 days. So we can make a 0.35% return, which works out to 5.8% annually if we did it repeatedly. If we did this every 22 days and just let the contracts expire, and we're able to get 18 cents every single time, and they were never assigned, if the stock just stayed the same value, we would collect the dividend, plus we would collect an extra 5.8% in option premium. So now the next part of this chart is what would happen, how much would the value be if the stock moved? So, and it's just percentage based. So let's just say that it's currently trading today at 1922. What would the account value be inclusive of the cash made from selling the options if the stock moved 10% to the downside? So if the stock went down $1.92, we would have $1,736.56, and this is 100 shares in stock. And then we would also have this 676 in cash. So that's where that number is coming from. 5% we would have 1832. 0 we would have 1928. And so we make a little bit of profit if the stock didn't move at all. 5% up, 10% up. You get the idea. You can kind of see how this goes. Now down at the bottom, this is just a reference. What if we just purchased the shares? Well, if I just purchase 100 shares, I'm putting up the same $1,931.99, but I'm not collecting any premium from the selling the call. So my total capital at risk is actually a little bit higher. It's actually equal to the amount of money that was debited from my account. And the future value, if the stock doesn't move, If it doesn't move at all, it's going to be 1922. So you can see that the difference there is literally the amount collected. So in this case, one contract would give us $6 more. So that's why the value, or this sell, 1928, is worth $6.76 more than just buying 100 shares outright. So in this case, if the stock moves up, all of these green cells would be a better move. We would have more money if the stock went up. Now, if the stock stayed the same and didn't go up at all, we would be better off selling the covered call against it. And if it went down, again, we would be better off selling the call against it. But it's only relative to this value here. So if the option premium is worth a lot more, it makes more sense. Let's just say theoretically it was 36 cents, and let's see how that changes things. Well, first of all, one contract is now, we're now collecting $24 compared to the $6 that we were collecting before. And it's still red because it's still below our assignment fee. So if the price of the stock goes up, we're actually going to be losing money because we don't have enough contracts. Now, if you've got deep pockets and you can afford to buy, say, 400 shares, then all of a sudden that's kind of into this area here where even a 5% gain is greater with the option than just selling the shares by themselves. So really what this shows us is that selling a covered call doesn't make us a lot of money if the stock goes up substantially. So it is, when you enter a contract like this, you really have to think about what you think is going to happen with the shares. If you think they're already at high value and the share value is going to drop, that would be a time when looking at putting on a covered call would be a good situation. But if you think the stocks are going to continue to rise, then that might not be a good time to put on a covered call. Now, in the case with Alta Gas, I mean, I think that there's still more upside potential. So unless I had a huge amount of shares, I probably wouldn't be looking to put on this trade because it doesn't make a lot of sense for me to collect, say, $59 on 200 shares and then potentially get assigned, make less money, and have this $43 taken away from my $59 profit. So this assignment fee becomes extremely important. Now, if you have no trading fees, then all of this changes dramatically. Putting on this contract at 18 cents, without those fees in there, using much smaller account, you can still generate like an extra 15% a year. And that's where these fees just kill us. I hope soon in Canada we're gonna have reduced fees, but for now they're pretty high. Anyways, I'm sure that generated some questions. I hope you guys got some information from that. If you want to play with your own numbers, feel free to download the spreadsheets. I'll put the links in the description down below, and there will be a link at the end of this video somewhere here. So thanks so much for watching. Remember to hit that like button, and I will see you very soon so we can get rich together.